Hi, everybody. Welcome to the podcast. Today we have Anthony Roddy back. He's from MortgageWorks. Anthony, welcome to the podcast.
Thank you for having me.
And of course, as always, our lovely co-host, Amanda Calabria. Amanda.
Hello.
Awesome. So, Anthony, today we'll be discussing mortgage recycling.
Yeah, mortgage recycling. I think loan purpose and tax deductibility versus non-tax deductibility of loans.
Welcome to the Passive with Property podcast, hosted by Dragan Dimovski and co-host Amanda Calabria. With over 2 decades of property investing, Dragan is a qualified property investment advisor and buyer's agent. We're committed to the education of both first-time and seasoned investors in property investment and wealth creation. The Passive with Property podcast is brought to you by the Buyers Agency Australia.
So for people out there who haven't listened to the podcast with Anthony before, Anthony, do you want to just a little rundown about yourself?
Yeah, so I've been in mortgages for probably coming up 11 years and in financial services as an accountant, previously chartered accountant, working specifically in income tax for a few years prior to that, so probably all up 15 or 16 years.
Yep.
We're MortgageWorks based in Surrey Hills and also have brokers across the country as far north as Townsville.
Amazing.
Helping people with all their financing needs.
Fantastic. And we'll leave obviously a link below with your contact details. So we'll definitely do that. So Anthony, mortgage restructuring. So for listeners out there who don't know what that is, can you break it down for me, please?
Massive topic, and one that I see a lot of in social media and podcasts, or probably more sort of shorter videos on social media. Occasionally I get sent videos from friends and colleagues saying, is this right or is that right? So it's a topic that a lot of people talk about, and I think there's a lot of confusion around. And so, I guess the idea of recycling your mortgage against your home to all of a sudden make it tax deductible is very attractive to the uninitiated. And there's some big do's and don'ts, effectively, which we see. And I would start off by saying this is not tax or financial advice today, and obviously anything that we discuss, run it past your accountant. And sometimes you get different interpretations over time as well, and that's probably just a sign of slight changes in tax rulings and whatnot. But certainly it's been nearly 11 years since I was a practicing accountant in tax, so probably certain things have changed, but by and large, the principles remain the same.
Okay, so for a first-time investor out there, what would you recommend? How would they begin?
Well, everyone's vision and journey is different, right? When they purchase a property, some people might be rent vesting. That's a very simple scenario where you're buying a property not where you live or not where you intend to live, perhaps because you don't have the budget to get in where you are currently living or where you want to live. And that's very straightforward in terms of structuring that correctly. But a very common scenario we see, particularly in the capital city markets, is sort of the hop, step, jump type movement, where people are buying a property today with a view to one day renting it out, keeping it as an investment, but it's not the forever home, just based on budgetary constraints. So getting that structure right, and also, I guess, not jeopardizing future tax deductibility of interest against that future investment property should you hold it. That's the discussion we're having a lot of the time.
So to sort of bring it back a little bit for those that are absolute beginners,
yes,
you've mentioned tax deductibility a couple of times now, and I find that we often get a bit of confusion around that from clients around what that actually means. You know, does it apply to the interest or the entire repayments? Does it apply to, if they've used their home to finance the deposit for their investment? Can you just run us through what you actually mean by tax deductibility and when and how it applies?
Yeah, sure. So principal payments are never tax deductible. It's only the interest component. So be very careful with that when you're doing your tax return, particularly if you're self-lodging. But using and to your question, I think what you're pointing to specifically, Amanda, using your home as collateral for an investment purchase, you can effectively get tax deductibility on all of the debt because the ATO will look at the purpose of the funds, not the security backing it.
So all of the debt towards the new purchase.
That's right.
Yeah.
So if you had a property worth $1 million and you had $500,000 owing on it, as a straightforward scenario, and you wanted to buy an investment property for $500,000, and you might incur $25,000 in transfer fees, stamp duty, legal fees, etc. You could borrow the whole 100% plus costs for the new purchase by crossing in both properties, so your existing property and the new property, but just borrow the whole amount required for the new purchase, and that makes all of that interest tax deductible for that property.
So it's the same thing as when people look at tax deductions at work. The cost of making money essentially is deductible. Would be the rule of thumb.
That's I can't remember. It's testing me now whether it's Section 8.1 or Section 6.1 of the Tax Act, which is as the costs incurred in generating income, assessable income. So if there is a genuine cost incurred in gaining assessable income, and obviously interest going towards a property which is earning rental income for the period of time that it is rented, be very clear on that, then it's tax deductible.
So the idea is that because your place that you're living in doesn't generate an income, that's the debt that you want to offload, pay off first.
That's right.
But preserve the debt on your investment properties. If you have any debt at all, that's where you want it to be.
That's right. And very often we see a scenario where, going back to the hop, step, jump method, which I've never used that term before, but it's pretty much what explains what happens, is people might buy their first apartment, for example. They get into the apartment, they do everything right, which is what the advice they've been given from parents and older generations, pay the debt down as quickly as possible. And they get into a situation where they've got very low leverage against their existing property. All of a sudden, they've got promotions and the time's moved on and they need more space, maybe a growing family, whatever the scenario might be. They've also got additional income, and so they want to upsize into a bigger property. And at that point, they need to draw all of that money out from the existing loan that they've used to purchase the first property and put it towards a bigger principal place of residence, at which point they've got a very lowly leveraged investment property that they've retained and a very highly leveraged non-deductible debt in the new property.
So what should they do instead?
Well, there was a time 7 or 8 years ago where we would effectively ask that question to clients up front. What's your plan for this property? If you see someone buying a 1 or 2 bedroom apartment, young professionals, couple, for example, if there was any intention, I used to say any less than more than a 90% chance that you might keep this property as an investment in the future, then it's a good strategy to actually go interest only on that loan, so you don't pay down any of the debt. Of course, you'll have additional cash flow under that scenario, so you compile the additional funds in the offset account, so it never actually touches the loan, the liability itself. Fast forward 5 years, if you draw those funds out to put towards a new principal place of residence, the existing loan hasn't been touched, so it's fully tax deductible. So you've got a tax effective strategy and a lower debt against your new principal place of residence.
So for those that respond to that, because we get this question a lot, okay, I've paid down my principal place of residence because I didn't know any better, but that's okay, I'll just redraw against it to buy my investment. Why does that not work?
Definitely need to have a chat to your accountant about that one. And even the banks have cottoned onto this because it's not correct from a tax perspective. I can tell you that. Sometimes you see smaller equity releases, which the banks might let slide, but it's just a rounding up effectively to the nearest 10,000 type scenario. But if you've got a situation where own $1 million property, you borrowed $800,000, you've paid it down to $200,000, and now you want to get out. Let's say the property's gone up in value and you want to draw out $1 million, for example, to put towards a new purchase of a primary place of residence, principal place of residence, then that's a big no-no, because effectively only $200,000 of that loan is tax deductible. And if you start claiming, $1.1 million.
So we're looking at purpose versus security.
Exactly. So just people think that because I'm drawing it out against a property which is an investment, which I once lived in but now I'm going to be renting out, because I'm drawing it out against that security, it's investment in nature. But the ATO says, what's the purpose of the funds? So we don't care what security is backing the loan. What did you take the loan out for? And it was to buy a principal place of residence. So the purpose of the funds is actually private in nature.
What about the other way around, where we're taking money out of our principal place of residence but still living there and then buying an investment property with that money?
That's where you maximise it, right? And I've seen that's a really that one's been quite. I've seen 2 really recent examples where I gave specific advice to a client around structuring for that exact scenario. Both of them had massive amounts of equity in their owner-occupied property. One of them was actually north of $2 million in their owner-occupied residence. And they had a tax problem, which is not uncommon when you see that amount of equity in a couple of investment properties. They're high-income earners. So they had a situation where to minimise, to just get some more tax relief, and obviously they were easily handling their mortgages based on their incomes, they wanted to go and buy another investment. Now, the applicants actually said to me in the first instance, look, we're happy to put $150,000 of our cash towards this. They had about $300,000 there in cash. We're happy to put $150,000 down for the new purchase. So if we buy it for $1 million, we'd like to borrow $900,000. So transfer costs, they might be in for $1.05 million with stamp duty and whatnot. They wanted to borrow $900,000 and put in $150,000 of their cash. And my advice was, why don't you think about that, about $300,000 owing on their owner-occupied at that point? I said, why don't you think about putting $150,000 onto your owner-occupied loan? We'll reduce the limit for you so you're still keeping your repayments manageable by lowering that debt. And then you borrow $1.05 million for the new purchase. So it's just that little change in, I guess, behaviour or change in mentality.
Because the total debt figure is the same, isn't it? It's
Total
just where
debt,
it's assigned.
Total debt figure is the same. Repayments are slightly higher under the situation because your investor interest rates are slightly higher.
But they're deductible.
But they're tax deductible.
Yeah.
And when you look at interest rates 6%, on $150,000, you're getting $9,000 in interest deductions there per year. And at their tax rate, that's $4,500, close $4,000 to $4,500 in additional cash flow per year back in tax.
Yeah, you own 5 or 6 properties. That's your school fees covered.
That's right. Significant.
That's right.
That's significant. So just that, and that's a $150,000 scenario, which is kind of at the lower end of what you can see a lot of the time.
Right.
So, Anthony, what about cross-collateralization?
Again, this is something which is always a case-by-case type scenario. A lot of people that come to me that are looking to buy investment property number 2 or 3 or 4, whatever the scenario might be, they're against crossing in their properties because they've been told, whether they've read something online or they've seen it on videos or whatever the scenario might be, or they've been told by family members that have bought multiple investments not to cross in their properties.
Can you just, tell us what that is?
Yeah.
Okay, so cross-collateralisation, taking it back a step, is where you put up either your home or another property as additional security for a new investment purchase.
So you're like your own guarantor.
Effectively. So you might have your family home might be worth $2 million if you're very lucky, and you want to buy $1 million investment property, for example. You go to the bank and say, you can have both properties, so $3 million in security for the loan that I'm taking out for the investment property. Okay, so you're giving the bank a lot more comfort and taking out the small loan just for the investment property in that scenario. So you're actually giving over 2 sets of title deeds, sometimes a lot more. Sometimes we see 4, 5, 6 properties crossed in. Now, the bank loves it because it reduces their risk, right? So if you're giving them $3 million in security versus $1 million in security, and you're only taking out $1 million loan for the purchase or $1,050,000, they've got a hell of a lot more security for that one loan. So they've got 2 properties they can sell in the event of default. So
they sell the better property first? So I think that's what people are scared of when they cross in, that if their investment property is the one that defaults, they'll lose their home because the bank will sell the higher value asset first.
Oh, look.
I mean, you've got to get to that point.
I must say,
but
it's hard for me to give you very clear advice on what the bank will do in that situation, because what do we see? Less than 0.5% of Australians default on their loans.
Yeah.
So I think the banks only provide for about maximum of 1% or 2% of loans to default. So we have an incredibly low default rate in Australia. So we don't see repossessions often. Right, and resales,
and that's because our banks here are pretty strict on when they give loans.
They're very prudent.
Yep.
They're very prudent. It's highly regulated. The financial industry is highly regulated by APRA. We have very solid lending standards, responsible lending standards. So, in theory, we make it hard for people to get themselves into a bad situation if they're very forthcoming with the lender. And that's a big positive. You see other countries where things are far less regulated, and then you have these boom bust cycles, which we don't tend to have in Australia. We certainly have booms, of course, but we don't have the massive busts because lending is so regulated. If you're ever going to see a bust, it would have been in the last 4 years, right, with interest rates doing what they did. But because of the 3% servicing buffer, a lot of people manage to hold on. So, yeah, that's one element of it. But of course, in most cases, the bank would come to you for a discussion. So if you were behind on your mortgage repayments, the bank will come to you for a discussion and say, what's the strategy? They have teams that are designed to help people that are in distress. And of course, then the banks aren't in the business of kicking people out of their homes onto the street. So they'll do everything they can to avoid a situation where you're evicted from, pushed out of your home and the property sold from under you. I think in a lot of cases, which is what they do with guarantor loans, and it's a good question, man. A good sort of analogy to use there. They are similar. You're sort of guaranteeing yourself when you put up your own property for an investment purchase. And with guarantors, a lot of the time in the guarantee and indemnity document that the guarantor signs, they sign off saying that if in the event of default, and the bank obviously sells the borrower, so the child in most cases, their property first, if they realise a loss, is the guarantor okay to convert that loss into a loan against their security? Okay. So rather than actually, and would they have capacity to repay it? So it's not a full servicing assessment like a new borrower, but they actually ask that question. So, and I've never seen a guarantor loan go bad, thankfully, and hopefully never will. But I think in a lot of cases, the banks would actually convert any deficit into a loan against the parent's security.
I've got a question for you, Anthony. I've had a call last week, and I had a gentleman say to me, "Okay, so what if I first-time investor, I put down my 10% deposit.
Mm-hmm.
I do obviously with the LMI.
Mm-hmm.
Property is valued at $1 million, and in 2 years it falls back to $800K. What happens then?"
Well, that's the benefit you have in Australia in terms of property as an asset class compared to some other asset classes, is that as long as you keep making your loan repayments, the bank doesn't revalue your property down the line and make a call on the debt.
Yep.
So they don't say, oh, gee, that property is, they're not randomly going through or on a cyclical basis going through and checking the values of properties and saying, oh, we lent you $900,000 on this, now it's worth $800,000, you have to put in $180,000
Because I know in some countries they do that.
That's right. Well, I haven't heard of that exactly, but I know that's what happens in the share market, obviously. That's why a lot of people got into trouble with margin loans during the GFC.
Yep.
So if you leverage against the shares and the shares go down in value,
that's right.
They just turn around and make a call. You have to top up the funds to reduce the LVR. So, that is one benefit of, as long as you're the asset class of property in Australia, is that as long as your serviceability is okay and you can afford to hold on to the debt, short-term fluctuations or even medium-term fluctuations in asset prices don't impact your ability to hold the property.
Okay.
What about in the instance where, I suppose we're coming back to debt recycling now, but I just sort of had this question when you mentioned when a property falls below the value of the loan and then the loan is worth more than the security.
Yeah.
You get people that, with that mentality in mind, they want to keep the debt on their investment properties low. We've seen people where they bang on about cash flow, right? Clients really love their cash flow because in their mind, that's how they justify the investment purchase. So what they try to do is, again, in their mind, they justify the maths as well. I can handle a mortgage on my home at this amount because of my work, my income. That's the mortgage I can handle on my home. But on the investment property, I want that to be cash flow positive. So I'm going to keep the debt on my investment property low because then it's safer. It'll never fall below the value of the loan, like that, risk that Dragan's client brought up last week. So for people that do try to debt, and I know we touched on this and that the total loan amount is the same, but just to help people wrap their heads around that, even in the instance that that's the investment property and the loan is worth more than the property, they're still better off tax-wise, aren't they, than if they try to top up their own loan from their principal residence?
That's right. And I guess people might have a medium-term view or a short-term view in terms of that investment purchase. They might be thinking, they might be in a bit of a rush towards retirement, for example, and they're thinking, I might need to sell this property in 5 years' time, so I don't want to have to convert a loss or realise a loss at the time that they sell the property. And they probably need to investigate whether the property asset class is for them in that situation, because I can understand someone who might say, well, ideally I'd put some cash towards the investment purchase because if I do have to sell it and I'm debt-free on my owner-occupied at that point in time, I just want to be debt-free and take some cash out of the investment purchase. And if something goes wrong, I don't want to have to put a loan back against my home. The reality is you'll just still have a larger debt against your home because the debt's got to be somewhere. It's either a smaller debt against the investment property and a bigger debt against your home, or a smaller debt against your home and a bigger debt against the investment property. And realistically, you should have a long-term view with property, as I'm sure you're discussing with your clients, that, ideally you'd be holding the asset class for 5 to 10 years at a minimum, so that even in the event of a sale, this is where cross-securitizing is this is the discussion point for me, really, is that and I always think when a client asks me about cross-securitizing and the risks, I always say, well, what's the only risk is that you sell and then you have to contribute some cash from somewhere because you're selling for less than what the balance of the loan is. So either you hold the property for an extended period of time so that is just not possible by paying down the loan at the same time, or is there any other issues around discharging? So when you actually sell the property, will the bank restrict you from discharging the property when the loan when you're due to hand the keys over? That's the big issue for cross securitizing. And if there's no risk, and I see some clients where they might have equity across 4 different properties, so their combined LVR is below 50%. So they've got the debt against their properties is less than 50% of their total property holdings, and they're worried about crossing in for a new investment property. But I know that should anything happen with that investment property, we can easily sub one of the other properties in. You can take your pick. So there's very low risk for that client, and really there's upside as well, because keeping in mind when you present to the bank as a lower risk customer by giving more security, you get better rates, right? So anytime you've got more debt and more security with one particular lender, they'll attack you more for your business effectively. So it sharpens the pencil and gets you lower interest rates across the board. So that's always what we're weighing up is there a risk of not being able to discharge this? If there's no risk, then there's really on the upside because the interest rate will come down.
What about in the event of inheritance? So let's say that somebody's, inherited a property from a family member that's passed away. It's not a property they want to live in, but it's also not a property they want to sell. They've inherited it unencumbered. So they see, great, I can earn a rental income from this property that I've inherited.
Yep.
But there's no loan against it. So there are no tax benefits on the interest because there's no interest being paid.
Mm-hmm.
What can those people do short of selling that property? What can those people do with available funds that are there, but from a tax perspective? I know you're not a tax accountant, but
yeah.
What options would you put in front of a client in that situation?
Look, it's difficult to put any option. Unfortunately, there's not much you can do. To the letter of the law, there's not a hell of a lot you can do in that scenario. You've got, and we do see that on occasion. We see someone who might inherit a property which is incredibly cash flow positive, and they've got a big non-deductible debt against their home, for example. And a financial planner might actually advise, and I've had financial planners advise my clients holistically on these types of property scenarios, and they actually say sell the property that's got no debt, incur the transaction costs, pay down the loan against your home, and then go again and buy another investment property, because that's
washing it out.
That's debt recycling effectively.
Yeah.
It's paying, using the funds to pay down a non-deductible loan and then turning it into the same amount of debt into a deductible loan. And that's the most common one you see in places like Sydney and Melbourne, Brisbane and Perth, all capital cities and built-up areas, is where people have got in and had to use property as a stepping stone to get into their family home. They've paid down the loan to such a degree that they've got a very tax ineffective structure, because they've leveraged high for the big property purchase.
How difficult is it to retroactively restructure? Just say you're 3, 4, 5 properties deep and you realise at that point, okay, I've stuffed up my structuring. How difficult is it to retroactively, you've got a combination of inheritance, redraws, top-ups, this, that, whatever. You've just done what you thought was right, but then realised you're not operating in the most tax-effective structure. Do you have to sell everything down and go again, or can it be fixed?
You've got one or two options, really. You pay tax, which is a good problem. As I mentioned earlier, my dad was an accountant for 30 years, and I was growing up and I started my accounting training, and my dad always used to say that paying tax is a good thing. It means you're earning income, right? Yeah. So you either pay the tax on the income if you've got a cash flow positive investment, or if it's a situation where it's really bothering you and it is a tax ineffective structure, then the question is, how long will you wait to sell it, to sell the properties and restructure effectively? Because every day that it goes on, it costs you.
Yeah.
Now, if you go to a financial planner that helps you map this stuff out, they'll actually come up with a break-even point. So they'll say, if you sell property 1, 2 and 3 and incur 2% selling costs to an agent, marketing fees, et cetera, and then you buy 3 new investment properties and pay stamp duty on each of them, et cetera, this is the cost you'll incur, transactional costs incurred. And based on the restructuring of the debt and the interest deductions that you'll get over time, year 4 or year 7 is going to be the break-even point where you're ahead. Now, that break-even point will get longer the longer it goes on. Okay?
Yeah.
So
there's no real other way other than sell and start over.
you see people try and, refinance and cash out up to 80% against an investment property, but say they've paid the loan down to 40% of the value of the property and they try and refinance and equity release up to 80% and then, go on to the next bank and then make another purchase and whatnot. But a lot of the time the banks will actually pull you up on that because you have to be really clear on what the purpose of the funds is. And the banks are aware of the tax rules. So a lot of the time, even a really common one, probably the first to move on this over the last 10 years, I'd say CBA. If they saw that you were refinancing and taking out an equity release with the view to buying a new principal place of residence, they would make you split that loan into 2. So the existing loan was investment in purpose. The equity release is owner occupied in purpose. No negative gearing in the calculator attached to that loan, so it impacts your borrowing capacity as well. And because they know the purpose of those funds is to go to a principal place of residence, which is absolutely correct from a tax perspective. I'm sure people do it all the time, little equity releases or even sometimes maybe bigger equity releases to recycle debt, but that's not what recycling is. It's effectively, just circulating and flushing debt into.
So when you talk
investment.
about split loans, just to be really clear to listeners what that is, that's more than one loan against the one property for different purposes.
That's right, which you can have and you see it all the time. So you might, owner-occupied is a really good example. So refinance your owner-occupied property and take out $200,000 to put towards a new investment. You haven't found the investment yet, but you need the deposit available. So you refinance and set up an investment loan split. Some people do it for shares and all sorts of other different things. I'm sure some people are doing it for crypto these days, but the banks don't ask too much unless it's a really large equity release. But yeah, so if you take out that extra amount, the bank will typically ask you what the purpose of the funds is, and unless it's cosmetic renovations to the property or major upgrades to the property that you're living in, it will have a different purpose. So it'll be classified as investment and a separate loan.
So with all that in mind then, what's the smartest way to use offset accounts?
Again, this will depend case by case. This will be a case by case type scenario. A lot of banks now are allowing up to 10 offset accounts per loan. Really good example, a client of mine settles in a couple of weeks actually, and they've got 4 investment properties and they've just bought a new owner-occupied property. They had lending across 2 different banks previously before coming to me. And based on certain policies, there was one lender which was a clear standout. Now, because they've got a lot going on, they're both in full-time employment. They'd like to have an offset account for each of the rental properties, so if they can keep the rental income coming in to each of the 4 buckets effectively and treat each offset account like a bucket. And then the expenses relating to that investment property will come out of each bucket for specific properties. And they want one owner-occupied offset account as well. Now, the lender we went with allows up to 10 offset accounts per loan split. So whilst setting up the 5 different offset accounts and giving them different names and clearly identifying them for the customer for cleanliness when it gets to tax time, we're making sure on the back end that all 5 loans are offsetting their owner-occupied property. So because there'll be, a float of, call it $5,000 or $10,000 in each offset account throughout the year, that might add up to $25,000 to $50,000 across the lot throughout the year. That's a material saving to be having it against your non-deductible debt, being the home loan. That's probably one benefit that we're seeing at the moment. But obviously, I'm a big advocate of offset accounts generally. I very rarely recommend a variable product without an offset. Very rarely, really only in instances where people have a very small loan amount, sort of less than 200,000, and they intend to pay off the loan very quickly within 2 years. That's probably the only time you see that an offset account's not really worth it.
So to address the psychology of it for people that want to pay down their debt as quickly as possible, you'd rather people put that money into their offset than onto the loan. We don't want to give it back to the bank. We want to keep it liquid.
Again, every person's different. I'm sorry, I sound like a broken record, but some people feel much more comfortable if their money is actually sitting on the loan, not in an offset account with a debit card attached. All sorts of scams and frauds going on these days. So sometimes people feel more comfortable if the majority of their money is sitting in the redraw on the loan balance. Again, if they've got a fairly vanilla structure and they've got the one property, maybe one investment, they want to keep the bulk of their money sitting in the redraw and just keep a float of $5,000 or $10,000 sitting in their offset account for, daily, monthly living expenses. I'm not against that, but you just check with the lender that they don't sweep that redraw.
So what does that mean?
So there was a pretty high-profile incident there a few years ago where I think it was ME Bank decided to start. It was right around the time that COVID happened, where, and I'm sorry if I'm slightly incorrect with dates here, but I'm pretty sure it was right when COVID happened. ME Bank made a decision to sweep some redraw accounts. So there was a customer there that was effectively semi-retired, and they had $35,000 sitting in their redraw. They weren't using an offset account, so they had all of their basically safety net money sitting in a redraw account, and they just logged into their online banking and found that it was gone. The bank had just decided to sweep the $35,000, not give them access to it, reduce the loan limit, and reduce their monthly repayments for them.
Yeah.
Right? So
without any warning.
Without any warning, and so that customer, the only way they could get access to that $35,000 would be to reapply for the home loan. So they have to. Now they can't because they're semi-retired, so they couldn't meet the serviceability requirements. Right now, it was a news story, and of course, ME backed away from it and made the funds available again and backed everything out. So, which was good on them. But the reality is the banks do have the power to do that. So, and it's all in the fine print that if there was ever an absolute catastrophe, if you've got any money sitting in redraw, the banks, for the purpose of their balance sheet, reserve the right to sweep it, right? So that's just one thing you want to be mindful of, particularly if you're heading into major life changes, be it semi-retirement, having kids, any situations where you may not be able to substantiate a new loan, or if you had to reapply, an offset account might be safer because they won't touch your offset account, transactional account.
Yeah, right. Very interesting. I think for a lot of people, it's having not just, investment knowledge, which is where we advise, but financial literacy as well. Because these questions come up all the time. It's not just as simple as, going to your broker and saying, what can I borrow? But what can I borrow and how should I structure it?
It's really hard, I feel, for people because a lot of the time, the advice that we give, I always have to say, you have to clarify it with a financial planner or a tax agent, right? A professional, and we can sort of point people in the right direction with regards to structuring. But the reality is that advice costs, and accountants, particularly in Australia, and financial planners, the cost is not cheap, and sometimes. The reality is financial planners are more interested in far more sophisticated clients that they can, might have $2 million in shareholdings, $10 million in shareholdings, whatever the scenario is, because that's where they get them the most of their fees. Effectively, that's how financial planners make a living, and same with accountants. It's very hard for an accountant, particularly a partner in an accounting firm who might hold the tax agent license. Their charge out rate might be $500 an hour to sit there and write, a piece of advice for an individual that's just looking to buy an investment property, and say, look, I'm going to have to charge you $1,500 or $2,000 for this advice. It's very hard for people to stomach that. So really, you say financial literacy. People that I see do it the best get very educated themselves. They talk to as many people as they possibly can, and they fact check everything they can. So rather than just sort of going straight off, a YouTube video or a Instagram video or something like that, they fact check things and learn along the way.
Anthony, thanks for today. Just to end it off, can we wrap this up?
Yeah. So I guess there are a lot of mistakes that you can make early on in the journey. So, to summarize, you'd probably say make sure you get your purpose and your structure right on the first purchase.
Yeah.
If there is an intention to one day potentially even 10% chance that you will hold that property for a future investment, then obviously you want to minimize the chance that you'll jeopardize future tax deductibility.
Yep.
So use an offset account rather than redraw. Minimize the repayments going into the principal, of course, stretch it over a 30-year term. As long as you're accumulating those funds in the offset account, you're no worse off. Have discussions widely, learn as much as you can before embarking on the journey. And then, of course, don't overstep the tax rules. So when you do make that future purchase, make sure you structure that one correctly. And then really flesh out, if you're going for purchases 3, 4, and 5, really flesh out the best use of your cash liquid funds at that point, because in all likelihood, if you have any non-deductible debt against your principal place of residence, you'll be far better off putting those funds towards paying that debt down and maximising the debt against the investment purchases. And don't be alarmed by cross-securitization. It's for 95% of cases I've seen, there's absolutely no downside, and it just results in better lending outcomes. So, yeah, that's probably...
Can I add to that as well? Be really upfront with your broker about your intentions. I think a lot of people will go to their broker and say, hey, I want to purchase an investment. What can I borrow? And then that's the extent of their, disclosure of their intentions. I think people... I don't know if people are, maybe you can shed more light on this, but I always find over-informing your broker leads to better advice as well.
Yeah, but I think dealing with you guys at MortgageWorks, you guys take that on anyway.
Yeah,
right?
we do make as many inquiries as we can. If we see a client brief and you've got cash and you've got an owner-occupied debt and you've indicated to us that you'd like to borrow X amount for investment property, and we can see that it might make sense to reduce we have that discussion. It might make sense to reduce the owner-occupied debt.
Because every time we pass on a client and they come back to us and they go, oh, well, I've spoken to many mortgage brokers out there and these guys are really, they get into the detail and they're very happy with the service.
Yeah. But it is really helpful if clients say to us, look, really black and white, we'd like to put this amount towards the purchase, because, and we can see there's owner-occupied debt there, so we can, that's their comfort level. So it makes our job very easy to advise them on how to structure it at that point.
And Anthony, how can the listeners reach out to you?
So we're at MortgageWorks, mworks.com.au. So feel free to reach out anytime, either through the website or through the landline, and we'll have someone help you out right away.
Thank you very much, Anthony. And Amanda, again, thank you very much. For listeners out there who, of course, want to get in touch with MortgageWorks, I'll have a link in the description below. And anyone who wants a discussion with myself or part of our team, we'll also have a link below. And again, thank you very much for listening, and until next time.
The Passive with Property podcast is brought to you by the Buyers Agency Australia.